Well, what is going on, guys, and welcome into the video. So I have been getting a lot of questions lately like should you stop buying now, or about timing the market, or using various option strategies and a bunch of other strategies to handle this downturn. Well, as someone who has actually invested through 4 crashes now, my strategy isn't based on a theory or a feeling or what I see is coming. It's grounding in having actually lived through it and invested through those 4 crashes. But I wanted to give you guys more research and facts from someone other than myself to see if I should, basically flip or not. I mean, should I stop buying? Should I sell and go away altogether? I mean, what the heck should I do? And I basically want to let the facts and the research and the numbers give you that answer. So I'm going to share that information with you today and see what the numbers say. I just asked in exchange for you to like the video and subscribe and do that for all the creators that you love. I mean, just doing those 2 things helps out immensely to those creators that you love, and they're free to you. And speaking of free, check this out just for you too.
If you want to speculate on a Chinese IPO, you've got my blessing to bet on Didi. I would try to get as many shares as you can. DID.
What is that actually? That actually happened.
Of course it happened. I think this is a reflection of how.
So check out the pinned comment if you're interested and give it a try risk-free. I mean, seriously, just cancel before the time expires and it costs you nothing. Alright, so I received a Tom Nash video from a group member a week or 2 ago, and in it, he referred to this article we are going to discuss today. So credit for Tom for finding it and sharing it with his followers, but I shared this article with my private group last week, along with kind of a long note answering a specific question and to kind of help with that discussion that was going on at the time. My strategy and message has not changed. I mean, I understand it may be boring and it does give me 4 unique videos a day of content, so some of my stuff is repetitive. But I'm not really into manufacturing drama, and investing is just honestly not that hard and doesn't require all that drama. This isn't the channel for you if you are looking for to the moon one day and then crash the next, or the newest weekly shiny thing that will make you rich or whatever. That's not how long-term buy and hold investors build wealth. That is how content creators build wealth. And you gotta kind of just understand the difference there. But due to all the sudden questions kind of out of nowhere that center around stop buying or doing some crazy option strategy or whatever, I felt instead of telling you what I would think and what I think I should do, I figured I would share this research with you guys too and see what the data says from someone other than myself. And I'll link the article in the description so you can read it too. It really is a great read and I encourage you to do that. So let's look at the assumptions used first so we understand the ground rules we're playing with. There were 3 market corrections in the past, in 2000 to 2002, in 2007 to 2008, and in 2020. And they mainly looked at the data related to these periods to answer 2 questions. Should you wait, keep investing, or double down during a dip? And the other question is, can you protect against downside risk? Also keep in mind this is for the S&P 500. And I know from personal experience the performance of individual stocks is far greater than the index returns are when you pick great stocks. So you can take the same methodology and kind of apply it to some individual stocks or a group of stocks or however the heck you want to do it. And this really answers the bell for the questions I have been asked the most, and it deals with modern times, not some obscure reference from the 1930s or some random country's stock market performance in the 1980s or any of the other things that are used to kind of prove a fear narrative. But let's get back to the article here. So they give us 3 investors here, and each of them invests $100 into the S&P 500 at the beginning of every month. And when the market goes below 10% of the previous all-time high, each investor reacts differently to the dip. Now, Cautious Charlie, as he is called, just holds. He stops investing and waits till the market is safe again, and when there is, confirmation or any of those terms that you hear out there a lot, and then he waits until it comes back to the other side of the 10% threshold, so he is still getting a discount, just not until he has confirmation of the next uptrend. Now, Average Andy just stays and continues investing as usual. Basically just DCA and move on, just DCA through the whole thing. And Daring Dave, he invests double the usual amount while it's down below the 10% mark until the market crosses that threshold again, then he's back to normal. And this chart right here shows you the performance of each character. At the end of 24 years, Average Andy and Daring Dave had returns of 334% and 370%, while Cautious Charlie lagged with a return of 239%. So the most profitable strategy is to double down during dips. but continuing to invest as usual also does great as well. But the big laggard was the guy who stopped investing altogether. And I know it's not on here, but the guy who sold and waited and tried to time the bottom and all the other garbage performed worse than all three of these guys, so those returns are not even in the ballpark, as that is basically a losing strategy long term. But how do the average returns look and compare in the short term? I mean, short term, this has to be the opposite, right? Well, once again, Daring Dave wins across the board, and here's the quote from the article as it sums it up best. Even in the short term, buying during the dip is far superior to waiting. You would have lost money by waiting, but made positive returns over even a 3-year and 5-year period if you had continued to invest, and the profits of the double strategy are almost 2x that of the hold strategy where you stop investing. The message is clear: buy the dip if you can afford to. And yes, unless you're a trader, a year is still considered short term. And maybe it is possible that the guy that waits leads over a few weeks or a few months, but by the end of the year, he is lagging big time. And I have no interest in winning for a few weeks or a few months. I want to win over years and decades. That is how true wealth is built. They actually went through a couple more exercises and points, but the results all pointed in the same direction as the two scenarios we just discussed. So check out the article for those. But the bottom line take on all of this is this: this strategy has been the best strategy regardless of how bad it has gotten, or which strategy you implement, or anything else. Over the past 20 years, it's amazing what all has happened that is way worse than now, and this strategy still was the best. And I can assure you, high inflation or high gas prices is not nearly as dangerous to the stock market as the financial crisis and the almost collapse of the entire financial system itself, which would include the stock market. We have also had wars that were far larger and far more costly than the war with Russia and Ukraine. I'm not saying that that war is not bad at all. War is something that nobody wants, period. We had the entire world shut down completely for the first time ever with no end in sight. We also had the most speculative bubble ever completely pop. I mean, seriously, if you just knew what the internet was and how to get onto it, you had an immediate $500 valuation on your company. That's how speculative it got during the tech bubble. And we had the most speculative housing bubble ever, where school teachers could get as many loans as they wanted for $300,000 homes, so that teacher owned $2, $3, $4, $5 million worth of property that nobody was living in, that would go up in value $100,000 in a year, every year, and that just everybody thought that was going to go on forever. Yes, that actually happened, and that is why that was the biggest real estate bubble ever. I don't think we'll see anything like that happen again. All of those have happened since I have been in the market, and guess what? The numbers still say the best strategy to make the most money is buy the dip. Not just for me, a guy who lived through all 4 crashes, but the actual data proves this over and over again. And if you want to go back to when we had 20% interest rates in the 80s, if you kind of want to go old school, this was still the best strategy. And going back to the last real world war we had, and buy the dip and hold was the best strategy. And go back to the Great Depression, and it still was the best strategy. Old school, new school, modern times, pre-internet, post-internet, doesn't matter. The best strategy over them all is the same, and I will be sticking with that strategy. And if you don't know how to get price targets, create a plan, or do evaluation, make sure you lock in your free trial today before the free trial ends. I mean, seriously, what do you have to lose? And click this video here if you want to see what I'm selling, and click here for exactly what I'm doing to make huge money in this market. So thanks for watching, and we'll see you in the next one.